For about a decade before 1997, the economies of East Asia were the envy of the world. The hardest hit countries had been growing faster than 5% a year, often approaching 10%. But underneath the boom, years of rapid credit growth and weak banking oversight were piling up doubtful loans and overheated property markets. To fund the expansion, these countries leaned heavily on foreign savings, borrowing from abroad and often at short maturities. Since 1984, Thailand had effectively held the baht at about 25 to the US dollar, a stability that lasted roughly 13 years. That calm felt like a guarantee. Banks and companies borrowed in dollars at short maturities because foreign interest rates were about half of Thailand's, and the peg was widely read as an implicit promise against currency swings. So much of that debt was left unhedged. This is the double mismatch. Borrow short, borrow foreign, and assume the peg never breaks. By 1996, the signals were flashing. Thailand was running a current account deficit of about 8% of GDP, roughly $14 billion, financed by short-term foreign borrowing. Property exposure ran to between 25 and 40% of bank lending. Then, on February 5, 1997, property developer Somprasong Land became the first major Thai company to default on its foreign debt, an $80 million Eurobond. It was the first visible crack. In May 1997, the pressure came largely through the forward market rather than the spot market. Speculators, reportedly including George Soros's Quantum Fund, shorted the baht through forward contracts, and the decisive coordinated attack hit on May 14th and 15th. The Bank of Thailand fought back, restricting baht lending to non-residents and intervening heavily, choosing to defend the peg rather than let the currency go. Here is the mechanism that turned a defense into a collapse. To hold the peg, the Bank of Thailand sold dollars largely through off-balance sheet forward contracts. By August, it disclosed obligations to deliver about $23.4 billion in the forward market over 12 months. Headline reserves had fallen from $37.2 billion in December 1996 to $30.9 billion that June, but once the forward book was netted out, usable reserves were a fraction of that. By the Bank of Thailand's own account, defending the baht consumed about $24 billion, roughly two-thirds of its reserves, and left only about $2.85 billion usable against $38.7 billion the year before. With almost nothing left to fight with, the decision was made. On July 2, 1997, Thailand floated the baht, abandoning the peg it had held since 1984. The currency fell roughly 16 to 17% that single day. The Prime Minister's June 30th pledge of no devaluation was already overtaken by events. He would resign by November. The former central bank governor was later sued by the state for about $4.25 billion over the reserve losses, though the courts ultimately cleared him. The float drove home a lesson investors quickly applied across the region: an overvalued Asian peg could break. Foreign creditors saw similar weaknesses elsewhere and pulled their money. On July 3rd, the Philippine Central Bank raised its overnight rate from 15 to 32%. The peso still slid from about 26 toward 46 per dollar. Indonesia widened its rupiah band, then let it float freely on August 14th. The fire was jumping borders. This was a sudden stop of hot money on a scale rarely seen. Net private capital flows to the 5 most affected economies swung from an inflow of about $93 billion in 1996 to an outflow of about $12 billion in 1997. That is roughly a $105 billion reversal in a single year, equal to about 11% of their combined GDP, driven mostly by commercial banks refusing to roll over their loans. Every devaluation also instantly inflated the local currency value of unhedged dollar debt, pushing firms toward insolvency and triggering still more flight. In October 1997, the attack reached Hong Kong's dollar peg. The Hong Kong Monetary Authority defended it by driving overnight interbank rates from about 8% up to 23%, and at one point as high as about 280% on October 23rd, to starve short sellers of cash. The Hang Seng plunged. Then, on October 27th, the shock went global. The Dow Jones fell 554 points, its largest single-day point loss at the time, triggering U.S. trading halts. A currency fight in Asia was now reaching American retirement accounts. Then, the panic reached one of the world's largest economies. Foreign banks refused to roll over short-term debt against roughly $100 billion owed by Korean banks and conglomerates. Korea's usable reserves drained to around $6 billion in November and as low as about $4 billion by December 18th. The won collapsed past 1,700 to the dollar. Korea formally requested IMF help on November 21st and signed on December 3rd. The rescue totaled about $58.4 billion, the largest IMF-led bailout to that point. The international community ultimately mobilized about $118 billion for Thailand, Indonesia, and Korea combined. But some conditions appear to have worsened the run before they helped. In Indonesia, the IMF program closed 16 banks on November 1st without a blanket deposit guarantee. Depositors could not easily tell safe banks from failing ones, so runs spread to other banks. Amid that and a deepening political crisis, the rupiah collapsed from around 2,600 to over 14,000 per dollar, a fall of more than 80%. Suharto, after 32 years in power, resigned on May 21, 1998. The bleeding eased not with more bailouts but with a creditor bail-in. After a December 24, 1997 meeting hosted by the Federal Reserve Bank of New York, the U.S. banks most exposed to Korea agreed to roll over their short-term loans. By January 29, 1998, about $24 billion of short-term debt was converted into government-backed medium-term loans, with the restructuring completed by April. Persuading the creditors to stay broke the rollover panic, a key turning point. The real economy paid the bill. In 1998, GDP contracted about 13% in Indonesia, roughly 10% in Thailand, and around 6% in South Korea. Unemployment surged, poverty roughly doubled in Indonesia, and foreign investors' losses in Asian equities outside Japan were estimated at about $700 billion by early 1998. The risk-off wave did not stop at Asia. It helped feed Russia's default in August 1998 and the near collapse of the hedge fund LTCM. A contagion pattern echoed again in 2008. The lesson hardened into policy you still live with. A fixed peg, an open capital account, and heavy short-term foreign currency debt are a combustible mix, because hot money can reverse far faster than it arrived. Asia responded by hoarding reserves as self-insurance, a shift widely cited as feeding China's large reserve buildup, and the so-called global savings glut that many economists linked to lower interest rates in the 2000s. The G20 Finance Forum was created in 1999 and the Chiang Mai Swap Network in 2000. When you hear a country boast about its reserves or a market panic over a currency peg, you are watching the long shadow of 1997.